What's going on? In this video, we're going to be taking a look at something a little bit more in depth than we normally do on this channel, and that is the EV to EBITDA ratio. And this is a very important financial ratio. I understand that this video is probably not going to be the most fun and overly exciting thing that you're learning about, but if you stick around and you pay attention and maybe even take some notes on this, you're going to be much better off than you were previously. So let's just jump right into this. Don't forget to give the video a thumbs up if you found it to be helpful, so that I know if I should continue to create new videos like this one. So it can certainly look intimidating, this ratio. It's a bunch of letters, it's a big acronym, but once we pick this apart, you'll find that it's really not too difficult to comprehend. So let's just break this apart so that we can understand what this acronym stands for and how we can use it to analyze a company. So this is a ratio that we can use to analyze a company to help us determine whether or not its shares are undervalued or overvalued. And it's definitely one of the most comprehensive and accurate ratios for determining something like this. Now when we go ahead and we break this apart, the EV stands for enterprise value, and this is just going to be a measure of the company's total value. So it would be market capitalization plus total debt minus cash and cash equivalents. That's how you would calculate that. And so that's enterprise value. EV is enterprise value. Now for EBITDA, that stands for earnings before interest, taxes, depreciation, and amortization. So that certainly is a mouthful. But what's the point of this ratio? If we're trying to figure out whether a company's inexpensive, why aren't we just using the PE ratio to determine something like this? And the reason for this, there's really a few reasons for this, but the main reason is because some people feel as though the PE ratio is not comprehensive enough to determine something like this. And so the EV over EBITDA kind of is a more comprehensive look at whether or not a company is going to be overvalued or undervalued, because both the P and the E in the PE ratio are sometimes just not enough to really derive a reliable figure for this. And so essentially all this EV to EBITDA ratio is doing is it's just replacing the price to earnings ratio with more reliable figures, at least in the minds of the people who favor this ratio over the price to earnings ratio. So when you're calculating EV over EBITDA, you may need to dig around a little bit to find some of these numbers that are necessary to calculate this ratio. It's probably not going to be calculated for you like the PE ratio usually is, unless you're using some type of special software for this. But you're not going to find this ratio on something like Yahoo Finance. So you'll need to spend a few more minutes just calculating this out, probably on your own, or maybe you might be able to find it somewhere on the web. But it won't be sticking out to you like the PE ratio does. But to analyze the EV to EBITDA ratio, you'll want to do the same thing that you do for the PE ratio. So once you calculate it, you'll want to compare it to other similar companies and compare it to their ratios, and possibly even compare it to the overall market to truly determine whether or not this company may be undervalued. So overall, this is a great ratio. A lot of analysts use it and they favor it over the PE ratio. I think if you want to truly be successful when you're investing in the stock market, it's a vital ratio that needs to be calculated before you purchase any stock on the market. And so if you have any questions or comments about this ratio, let me know down in the comment section below. This is just kind of the bare bones basics of this ratio and just the overall view of it. So hopefully you understand what this ratio is, and as you can see, it's really not too complicated, and it's not too far off from the PE ratio. So thanks for watching. As always, thanks so much, and I'll see you next time.